start the week with Gary Wagner and Chart This. He joins me from Hawaii now. Gary, good to have you back with us.
My pleasure as always.
Before we get started, Gary, I urge our viewers to look at a piece I did with you last week where I asked 5 traders their New Year's resolutions for 2014. You had told me you wanted to closely monitor the gold-platinum spread. Can you elaborate on this resolution of yours?
Well, certainly. Obviously, last year was a devastating year for many gold bulls and just gold traders in general. We saw it run down about 28%. There is the possibility of continued pressures as we started this year. Now, we've had a nice rally, but that doesn't mean that we're often running into a bullish market in gold. However, what I'm looking at is the fact that the equities markets have been on fire. And with an increase in consumer spending and an increase with consumers buying durable goods and whatnot, the raw materials needed, such as platinum in the automobile industry, could do very well because of that. And we saw platinum last year go under tremendous pressure, actually go under the price of gold. And I believe that there's an opportunity right now for platinum in terms of percentage gains over time to be much greater than gold. And that's why that's a spread that you should at least take a look at.
Gary, last time you were on, you mentioned how you feared the possibility of one more down leg for gold, but you also expect a bottom in the first quarter of the year. Would you expect this bottom to be in the near term or in the later months of the quarter?
Well, you know, the cycles that I look at are responsive for price, but not so much time. But in terms of where we've seen this market go, we are in the tail end of a downward cycle, the 5th wave of 5 waves. And once that does terminate, I believe that effectively we will have found a bottom. I would expect that possibly in the first couple of months, so sooner than later in terms of the first quarter.
Gary, also last week we had non-farm payroll numbers come out that caused movement for gold. Do these numbers mean anything for you when you're gold forecasting?
Yeah, I mean, the employment or unemployment numbers are interesting because it's the benchmark that the Fed has been using, and that is probably the single greatest reason that it is important to me, why I watch it. The job market has changed, and the first thing about the unemployment rate is it's not giving you true numbers anyways. It's not talking about the disillusioned, the underemployed, and so those numbers are actually greater. At the same time, you have corporations that have retooled to be able to accomplish the same tasks with less people. So we're in a different type of environment or climate, and so for that reason, you can have a higher unemployment rate but a robust economy. And it's the primary reason that I look at it is because the Fed watches it.
Great, Gary. On that note, what have you brought for us today?
Well, what we're going to do is we're going to continue to look at the 2 different models that I have been presenting to our viewers here at Chart This. One that is basically what's called a bear market truncation. It would look for the double bottom at 1181. We did match that. We did come off of that. But we're really at some pretty solid resistance right at around 1250 right now. So if it can break through 1250, I think we'll see a continuation of the rally. However, we could easily see it back off. I'm looking for the possibility of one more leg down. That final leg would conclude or terminate that 5th wave, and then we would go into what is called an ABC progression, meaning an upside rally, a small dip, and another upside rally.
Fantastic, Gary. On that note, let's get to it.
You know, it's hard to believe that we're already well into the first month of 2014. And in terms of what we've seen in gold, we've seen some really interesting activity towards the end of last year and the beginning of this year. For those of you who are regular followers of the Chart This series, you know that we have been talking about 2 basic models, Elliott wave models, in which we were looking for the low of the current correction that really was prevalent throughout 2013 when that would terminate. One of them, bear market truncation, looks for equal lows. We got that. We'll talk about that towards the end of the show. And then the other one was what's called a standard zigzag, in which the last wave down, so to speak, makes a low that's lower than the previous low, wave 3 to wave 5. When we look at the charts, there's absolutely no doubt we've had quite a nice little rally. I guess the first chart we'll take a look at is a 240-minute chart, standard Japanese average format. And the most obvious thing to me, so when we look at this chart, clearly on a very, very short-term study, this being our upper resistance line, we're simply drawing it from these tops here to here and extending forward. This was a dramatic, not only bottom, but what we like to call a V, a pivot point in which the market turned around. It did find support. This was approximately, I believe, 1186, and because of the time sequence of 240, you cannot see the secondary bottom. That occurred in July of last year. So market obviously breaks through this resistance line. You can see also that it finds its first real level of resistance as the market moves up at about 1243, comes down, finds support roughly at 1220. And then we had on Friday, of course, and last week, we had that tremendous rally to the upside, closing at 1248, but closing at, to me, a pretty critical point, because when we look at it, although it did close above this particular target line, we do have historical reference right in here in which there has been real resistance in the market. But there's no doubt, we have seen a dramatic rise to the upside from 1186. But that is only a real short-term study. The next chart we'll look at is a 720-minute chart, so each candle represents roughly a half a day of trading. And when we do that, first of all, you can see this double bottom that we spoke about right here. Our primary first bottom, this is 1181, and this is after the market is coming off of an $1,800 high and then moves all the way down to this low. Dramatic, tremendous move down. Really the only significant rally of 2013 followed, goes to 1435. When we do that, and this is just a very, very loose line, but it's a resistance line, really accounting for this entire dramatic drop. When we look at it through this chart, you can really see that in terms of concrete technical evidence that we had a clear and utter reversal. Yes, we've had that. Are we back in a bullish mode? My sense is, just in terms of straightforward technical analysis, until we actually cross this threshold, meaning the intersection between this rally moving up and this long-standing resistance line, would I be able to say, yes, we're absolutely into some sort of a bull cycle? If that was the case, the bear market truncation was absolutely the model that's unfolding. Now, yet another way to view whether or not we've seen a significant pivot point, what I've done here is I've pulled up a daily chart. This daily chart also contains an Andrews pitchfork. The way the Andrews pitchfork has been drawn is we fixed our high here, we then went down, fixed the low, and then our high. So these are the three variables that we put in: this low here, this high, and this high. And when we do that, what's interesting is if you look at how the pitchfork carries down that 100% mark, it's kind of interesting how as this market came down, this low pretty much matched up, and that's where we found some real support in the market. What I tend to try to do when I use an Andrews pitchfork is to look to see if it's breaking through these various channels or whether it's continuing its downtrend, so to speak, and staying within a particular set of channels. And that gives me a real clear indication. Now, what can be said of this particular run right now is you can see how it traded from the high to the low of this channel. We've not gotten to the high midpoint. Well, we've gotten well past it. These are our only two spikes, but then in a downtrend, you're going to see your highs. For example, this is your first set of highs. Then you'll look at the next level. This is our 23%, and we get a match here. So you look to see as the market trades down if the ranges are moving down the channels. In this case, as we look at it, nothing can be said except that we are still moving down these channels, because really we would have to start breaking through significant channels again before, according to this study at least, we could say that we're in a defined bull market. I'm going to go ahead and pull up this 3-day chart. It gives us, obviously, I like to use a 3-day in that it's has a little less noise than a daily, but a little bit more sensitive than a weekly. When we do this, we can see in terms of a defined bottom, this is in Japanese average format, of course, but we have this again, this variation where as the market comes down with our red dojis, our red candles, we get the V or the bottom of that, a beautiful doji, and then we go to green. On a 3-day candle, it becomes quite apparent that we absolutely found really, really good support at 1186. However, there's nothing conclusive in this chart yet that tells us that we're out of the woods and we wouldn't experience another leg down. And most importantly, we're really at a pretty critical point, a fork in the road, so to speak, because when we look at this weekly chart, what you can see and realize that my current count puts us at the beginning of our bear market count. 1, 2, 3, 4, wave 5. The question is, has wave 5 terminated? Now, a truncated bear market looks for this fifth wave right here, 1, 2, 3, 4, 5, this fifth wave to actually become what's simply called truncated, meaning that it would have a low that's equal to the last low. It's similar to an ABC flat in a bull market count. Now, we do have our first candle, which has gone green. That's pretty significant. However, on a weekly chart, it's going to take us a while before we see any kind of real pattern emerge. We'd have to see a couple more weeks to see a couple more green candles. But if this was to be a pivot point, in other words, if the bear market truncation is the model that we're going to look for this upcoming year to unfold, it would be something like this. We had 1, 2, 3, 4, 5 truncates. Now we're going to go into our A, our B, and our C. In other words, we could still be in a bear market, in a bear count, but we would go into the corrective phase, which is a counter trend phase. Clearly, the trend has been lower. Counter trend would put this as a higher market move. I really believe at this point that we are absolutely at a crossroads. And that crossroads really comes in when we look at short-term and then compared to our longer-term studies. Our short-term study clearly shows an absolute breakout, a double bottom being formed around 1181, and the market rallying off that. As I said, closing as of the end of last week, just below 1250. We've clearly broken through there. But when we look at the more long-term standing resistance line, and we can do that with either this particular half day or this daily chart, we by no means have gone and cut through this crossroad right here. And until we do that, we could get this particular market unfolding in one of two ways. As if it breaks through there, we have the truncation, or if it comes to the top of resistance and goes down, and that's the part that we'll cover in part 2 of our chart this series this week. Our after the show or bonus content will go into more detail in our current market forecast, but it's clear to see that we're at a crossroads, and it could, at this point, I really believe, give us some very important information in terms of where to look for gold pricing to go, say, over the next couple of months. Now, for those of you who want to see part 2 of this week's chart this, in other words, our bonus content, simply go to our website, and our website is thegoldforecast.com. When you go to the website, what you'll see on the front page is a area, chart this after the show, where you can actually go and sign up. We have created a members role for the chart this after the show. You will have to be a member. Membership is absolutely 100% free. When you click this, what will happen is it will take you to your sign up page, which is just like this. And all you need to do is click this button, create your username and password, and then you'll be able to log in and view the bonus content for this week, as well as all the following weeks, have access to our forum and our gallery of charts. There's absolutely no doubt we are at a pivotal point in the market, and depending on how it reacts when it gets to this upper level resistance line is going to give us a lot of information, and that information should actually start to unfold this week. Again, Elliott Wave are two current models as they pertain to current gold pricing.
Thanks, Gary, and we'll see you next week.
Well, thank you. It's a brand new year, and I'm excited to be with everyone here and to share what we can and to make all of our viewers more effective investors as well as traders.
Absolutely. On that note, Gary, have a great week. Happy trading. And thank you for watching this edition of Chart This. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Camboni. Thanks for watching.